LVR reports home sales were down 14.2% in August year over year, and sales of condos and townhomes are down 15.4%.
Nevada home prices jumped 89% in just a few years, but that run is about to reverse. Insiders now say values could drop by half by 2026, wiping out $147 billion in equity. Water cuts threaten 1.7 million properties. Job losses are climbing, and investors are bailing fast. There's one overlooked trigger almost no one's talking about, and it might be the biggest risk of all. This video walks you through the chain reaction that's already in motion and what happens next. In the span of just 5 years, Nevada's home prices exploded. From 2020 to 2025, the median price for a single-family house in southern Nevada climbed to $485,000, nearly doubling in less than half a decade. That 89% increase added $147 billion in new home equity across the state, much of it on paper and much of it in the hands of buyers who never planned to live in these neighborhoods. Charts from the Nevada Association of Realtors show a straight upward line, steeper than almost anywhere else in the country. But behind those numbers, something didn't add up. Wages for local workers, those in tourism, hospitality, and logistics, barely moved. The average casino dealer or warehouse worker saw little more than a cost of living bump, while the price of entry-level homes leapt out of reach. Apartments built in the 1980s now rent for as much as a mortgage on a new build. Locals say, "We wouldn't buy our own homes at today's prices." Dr. Miller, a housing economist at UNLV, describes the dynamic as a classic bubble, rapid price growth, driven not by income or population, but by outside investors and speculative buying. In 2024, more than a quarter of all home sales in Clark County involved institutional buyers, Wall Street funds, out-of-state LLCs, or cash flush flippers. The result is a market where the sticker price for a basic home can hit $550,000, even as the median household income struggles to top $65,000. Homeowner association fees, surprise assessments, and rising insurance bills pile on, pushing true monthly costs far above what most families can afford. For many, the so-called Nevada dream now feels like a trap. The gap between what locals earn and what homes cost has never been wider. That disconnect is fueling anxiety about how much longer the boom can last and what happens when the math finally breaks. Mia stands in her kitchen running the numbers again. The HOA bill just went up another $48 a month, and the notice warns of a possible special assessment for exterior repairs. Her neighbor across the street listed their house last week. 2 more for sale signs went up on her block this month. The official inventory count for Southern Nevada has jumped 82.8% compared to last year, with more than 8,000 unsold homes sitting on the market. Realtors talk about months of supply. In 2023, it was barely 2 months. Now it's pushing 4, with new listings outpacing sales every week. It's not just the price of homes that's changed, but the cost of keeping them. Mia's HOA started as $120 a month when she moved in. Now, between fees, surprise charges for landscaping, and rising insurance premiums, her monthly outlay is almost double. She's not alone. In online forums, homeowners vent about being squeezed by hidden costs. "I pay more in HOA and utilities than I ever did in California." Another writes, "If I'd known about these assessments, I never would have bought." The mood has turned. People who used to brag about their home's value now talk about how impossible it feels to sell without taking a loss. Open houses draw more lookers than offers. Some owners quietly admit they regret buying at the peak. Local agents say the flood of new listings is a warning sign. We're seeing people who never planned to sell but can't keep up with the bills. For families like Mia's, the numbers don't work anymore. A growing sense of unease hangs over neighborhoods that once felt like safe bets. The question isn't just how much longer prices can hold, but how many more owners will join the rush to exit before the next shock hits. Lake Mead's waterline sits at its lowest point in recorded history, exposing miles of cracked earth where boat ramps once touched the lake. The Southern Nevada Water Authority projects that without a dramatic reversal in snowpack or river flows, Nevada's allocation from the Colorado River will remain deeply restricted through 2026 and beyond. Under current federal shortage tiers, Nevada's supply has already been cut by 7%, but internal agency documents warn that deeper reductions are likely if negotiations with California and Arizona stall. California's senior rights guarantee its share comes first, leaving Nevada on the losing end whenever further cuts are triggered. Dr. Alex Garcia, a hydrologist who consults for multiple Western utilities, points to the legal frameworks that keep Nevada's water future uncertain. He describes the situation as a high-stakes standoff. If Lake Mead drops further, Nevada could face even harsher restrictions, with no recourse against California's priority. Builders have responded by pulling back. Over $2.3 billion in planned housing and commercial projects have been shelved, citing uncertainty over future water permits. The risk isn't theoretical. Up to 1.7 million homes in southern Nevada depend on Colorado River water. Modeling from the Bureau of Reclamation shows that if the most severe shortage rules are enforced, property values across Las Vegas could fall as much as 60% in a single year. Some Wall Street analysts are already betting on this scenario, quietly shorting Nevada real estate. For homeowners, the threat is clear. When water runs short, equity vanishes almost overnight. Emily Chin pulls into the parking lot outside the resort, her badge still clipped to her shirt. She's one of thousands in Las Vegas whose jobs depend on the flow of tourists, convention goers, and gamblers. But the crowds are thinning. Gaming revenue, once on a 31-month winning streak, has slipped for the first time in years. The casino where Emily works cut her hours last month. She's not alone. At least 19,000 casino jobs have disappeared since 2024, with another 70,000 supporting roles at risk across restaurants, shows, and supply companies. Amazon and Walmart are preparing to eliminate 73,000 warehouse and logistics jobs statewide by 2026, citing automation and shrinking demand. Official unemployment sits at 11.7% when you count gig workers and those forced into part-time. The state's unemployment fund is already stretched thin, with insiders warning it could run dry in less than a year if layoffs accelerate. Emily's paycheck barely covers rent, let alone groceries and utilities that keep climbing. She tried picking up delivery shifts, but gig earnings have dropped by as much as half. Friends talk about leaving, chasing jobs in Texas or Arizona. In Reno, the story is the same. Tesla and Panasonic have started cutting staff, and office vacancy has soared to 23.4%. For sale signs are popping up in neighborhoods where tech workers once drove bidding wars. With incomes falling and jobs vanishing, fewer buyers can qualify for a mortgage. The pool of potential homeowners is shrinking fast, and every lost job means another family forced to list their home or walk away. California's population losses have slowed, but a new dynamic is taking shape. After years of watching families and workers leave for Nevada, California employers are now quietly reaching out to lure them back. Tech firms and major hospitals in the Bay Area and Los Angeles are offering hiring bonuses, relocation packages, and flexible remote work deals to former employees who left for Las Vegas or Reno during the pandemic. The promise: return to California, bring your skills, and get help with moving costs, sometimes worth tens of thousands of dollars. The effect is showing up in moving data. U-Haul and other long-distance truck rental companies report a sharp increase in one-way rentals from Nevada to California in 2025, reversing a decade-long trend. The number of outbound moves hasn't reached record highs, but it's the largest surge since the early 1990s. Tech workers in particular are feeling the squeeze. New tax rules on remote work have forced about 47,000 high-income earners to reconsider their Nevada addresses. Many are now listing homes for sale, some at a loss, just to avoid double taxation and regain access to California's job market and benefits. For Nevada homeowners, this is a sudden shock. Neighborhoods that once filled with out-of-state buyers are now seeing a wave of for sale signs as those same families cash out or cut their losses. Realtors in Summerlin and Henderson describe a growing backlog of unsold homes, many owned by recent arrivals who no longer see Nevada as a safe bet. The pressure from outbound sellers adds to an already swelling inventory, making it even harder for locals to find buyers willing to pay pandemic-era prices. Only 11% of Nevada households now qualify for a first-time mortgage. That's the lowest share on record, according to state housing data. The typical entry-level home costs nearly 8 times the median income, a gap that has widened every year since 2020. For younger families, the math is impossible. Even with 2 incomes, rising electric bills and higher grocery costs eat up what used to be savings for a down payment. Healthcare premiums have jumped too, leaving little margin for emergencies. Retirees now outnumber new working-age residents in many Nevada neighborhoods. Census figures show that for every new worker moving in, at least 2 seniors are looking to downsize or cash out. The result is a growing surplus of homes aimed at buyers who no longer exist. Agents report that many listings sit for months, even with price cuts. Sellers who bought just a few years ago face the prospect of losing money if they need to move. Longtime residents talk about doubling up with relatives or leaving the state entirely. Utility bills have risen by more than 40% since 2021, and some families spend nearly a quarter of their income just to keep the lights on. The cost of groceries and basic services has soared, pushing more locals to consider selling while they still can. The buyer pool is shrinking, and with each family that leaves, the imbalance between sellers and buyers grows wider. Tom Chin checks his phone for new bookings, but the calendar is empty. He owns 3 short-term rentals on the edge of Summerlin, properties that once paid for themselves and then some. Now, like most of Nevada's 67,000 short-term rentals, his units are losing money every single month. The numbers are staggering. 73% of these properties are now cash flow negative. The average owner is down more than $1,100 a month, squeezed between falling occupancy rates and city rules that limit how often they can rent. Tom's mortgage is fixed, but everything else is climbing. His home insurance premium just jumped 67% since last year. The letter from his carrier warns that future renewals aren't guaranteed. 2 major insurers have already pulled out of Nevada entirely. Without insurance, Tom can't refinance or sell to a financed buyer. Meanwhile, his inbox fills with notices about new lawsuits. Construction defect claims against Nevada builders are up 567% since 2019. So, water damage, faulty wiring, mold. Problems that once seemed rare are now routine. Tom joined a class action against his builder, but that won't help him cover next month's losses. For thousands of small investors, the math has flipped overnight. What was once a safe bet is now a liability, and the pressure to sell is growing with every unpaid bill. A forensic review of Nevada's mortgage records from 2020 to 2024 reveals a surge in risky lending and mounting stress beneath the surface. Non-qualified mortgages, loans made outside standard underwriting rules, now account for more than a third of new home loans in the state. Many were issued to buyers with limited documentation or to investors betting on endless appreciation. As property values waver and incomes fall, early signs of distress are everywhere. Nevada leads the nation in foreclosure rates, with 1 in every 2,326 homes in default as of July 2025. Delinquencies and so-called zombie loans are rising, especially in neighborhoods with heavy investor presence. Banks and lenders, facing mounting losses and regulatory scrutiny, have started to accelerate foreclosures and call in loans at the first hint of trouble. The FBI has expanded its mortgage fraud team in Las Vegas, targeting brokers and originators tied to misrepresented applications and inflated appraisals. At the same time, institutional investors, who snapped up thousands of homes during the boom, are preparing for a hasty exit. Blackstone and other Wall Street landlords have internal plans to unload 15,000 rental properties in Nevada by the end of 2025. Many of these homes are used as collateral for billions in real estate-backed loans. As values fall, margin calls and forced sales become unavoidable. The result is a market primed for a flood of distressed properties. Every foreclosure, every investor liquidation adds to the supply, pushing prices down further and locking out any hope of a soft landing. The financial time bombs set during the frenzy of easy credit are now ticking down with no safety net in sight. 5 shocks hit Nevada's housing market at once in 26. First, $47 billion in commercial real estate loans come due, with values underwater and lenders demanding repayment. Office towers in Reno and Las Vegas face mass refinancing failures, forcing owners to dump properties at a loss. At the same time, the end of federal infrastructure spending wipes out 31,000 jobs. Construction crews, engineers, and contractors lose work overnight, just as the state's unemployment fund is already stretched to breaking. Adjustable rate mortgage resets strike next. 67,000 homeowners see payments jump by more than $1,400 a month. Many have no savings left after years of higher costs, and foreclosure warnings arrive in mailboxes across suburban neighborhoods. Nevada's state budget gap grows to $2.3 billion, forcing cuts to schools, healthcare, and public safety. There is no bailout coming. Federal and state governments are too deep in debt to intervene. Water restrictions, triggered by legal agreements as Lake Mead drops, ban new construction and freeze development. The housing market seizes up. With no buyers, no jobs, and no relief, home values collapse. Analysts warn of a 40 to 50% drop in prices statewide. For homeowners, the crash is no longer a risk, it's reality. Between 2020 and 2025, Nevada home prices soared 89%, putting $147 billion in homeowner equity at risk. This documentary has shown how rising costs, mounting job losses, and a surge of short-term rentals have strained the fabric of the state's housing market. Evidence from public records and industry reports points to a convergence of 5 major shocks in 2026: commercial loan maturities, water shortages, mortgage fraud, institutional sell-offs, and budget gaps. Many of the underlying documents remain partially classified, including the full extent of mortgage fraud investigations. While the exact scale of the coming crash cannot be known until these files are released, the facts are clear. Nevada's housing market faces unprecedented pressure from all sides. As federal and state agencies confirm they lack resources for a bailout, the question remains how fast and how far prices will fall. What is certain, based on the evidence, is that the risks for homeowners, renters, and investors have never been higher.